Stock valuation. Stock price divided by its most recently reported earnings per share, the price earnings ratio. This is also the most common way of estimating the value of a stock. You probably know that. So, going about estimating the value of a stock, there's a good chance that your approach will fall under two broad categories or straddle the two of them. One of these two broad categories is textbook-like, more rigid, and inward-looking, if you like. That is the absolute model. In this model, it is usually the fundamentals as it concerns the company that is considered. Fundamentals like cash flow. With the cash flow identified, the earnings per share history or values can also be identified as well. Dividing the prices by the earnings per share over one's desired period will help one establish a trend, if you like, as well as a growth rate. With the growth rate, then a price can be estimated. Looking at the free cash flow against the stock's price over the years can also help extrapolate the value of the stock. The free cash flow figures for growing companies may be negative but may still be useful. Then, there may also or may not be a history of dividends. If the company pays dividends, one can see what the present value of investing in the stock relative to what the dividends are like. This is simply estimating the interest rate an investment or investing in that stock might earn. The other model is more flexible, more accommodating, which is the relative model. The price earnings ratios determined or obtained in the previous model, that is the absolute model, can be compared to those of related businesses, those in the same sector, and indeed any parameter one deems appropriate. One can always mix and match quantities, compare and contrast, discount and compensate, and indeed employ technical methods. Approach it the way you see fit. Given these fundamentals, or this fundamental approach, one can see that they are not leading price indicators of what a stock is worth, as conditions are constantly changing and they cannot take them into account. So, when choosing a valuation method, make sure it is appropriate for the firm you are analyzing, and if more than one model is suitable, use both to arrive at a better estimate. Stock valuation: stock price divided by its most recently reported earnings per share, the price earnings ratio. So, the price earnings ratio is the most common way of estimating the valuation of a stock.